Hello, I'm Sandra Spencer and welcome back to Board Talk. My guest today is Ben Habib, who is the CEO of First Property, a stock Tom owns in the T1PS fund, and which reported its results for the year to March the 31st today. So Ben, welcome to Board Talk.
Thank you, Sandra.
Now firstly, as I understand, the majority of your revenues are earned from investing other people's money in largely Polish property. Now earlier this year, the zloty plunged, but it has now recovered. Now, so does this mean that Poland and Polish property is a bit of a high risk going forward?
That clearly with the zloty weakening, it does bring tenants under pressure, and we therefore have to take a more cautious approach to buying property.
So you're trying not to expose yourself too much?
Absolutely. Well, we're very happy to make opportunistic acquisitions where we see real value. But where you've got a stress such as the zloty weakening dramatically, you can't buy the market, as it were, on a wholesale basis. You've got to be quite discriminating in what you buy.
But from what you're saying, you're quite positive about the zloty for the future.
Well, it's actually forecast to go, at the moment it's 4.4 against the euro. It's forecast to move to 4 against the euro, which will put it in a very comfortable position as far as I'm concerned. I ought to just qualify what I'm saying in that the weakness of the zloty isn't all bad for Poland. It does, of course, make Polish exports more attractive. And one of our most recent purchases, for example, was a sale and leaseback with Indesit. And Indesit recently relocated both its Italian and its Welsh arms to Poland, largely because of the cost-effective nature of doing business in Poland and the skilled workforce. So the Polish zloty weakness is not a zero-sum game for Poland. There are upsides for it.
Okay, now clearly the earnings of First Property will report are linked to funds under management, which was £310 million at March the 31st. Now, is there any reason that this might grow? You warned that 2009 may be a testing year.
Well, we've always been cautious. We're doubly cautious at the moment. We do fully expect the £310 million figure to grow. Indeed, it has grown as a result of that purchase that I just mentioned by about £20 million since the 31st March. We are looking to buy more property in Poland. We will continue to look at buying more property in Poland. But we're actually keener now on the UK, where we're looking very actively at buying property in the UK, and we're in the early stages of negotiating our first deal, in fact.
Okay, and what areas of the UK for the commercial property?
Well, we love supermarkets. I've always loved supermarkets because they tend to be recession resilient. I wouldn't say anything's recessionary proof, but they're resilient. And indeed, this first deal that we're looking at is a supermarket. And I ought to also mention, before we move off this point, Sandra, that we used to be entirely UK-based as investors, but we took the view in 2005 to leave the UK because we felt prices were too high. But now that prices are much lower here, we're enticed back into the UK market.
But from 2005, did you realised a lot of value and made good money in the move to Eastern Europe? We
did. We closed our first 3 funds under management, which had invested entirely in UK property. We closed those, sold the property and returned cash to investors who did very well out of our run in the UK. And we sold the English property that 2 other funds owned and redeployed their capital into Poland. And indeed, we raised our largest fund in 2005, which was on behalf of University Superannuation Scheme, and we've invested most of their assets in Poland.
Ben, are you calling the bottom on UK property, and why?
I think it would be peremptory to be calling the bottom of the UK property market, but property values are off 40% from their highs. Yields are up dramatically. The UK economy has still got a lot of trouble that it needs to sort out, not least of which is the huge government and consumer debt that we're now burdened with. But given the yield movement and the relatively low capital values at which you can buy property now, even if rents were to drop going forward, which is what we expect them to do, we think that the UK market has fallen far enough for us to be able to find attractive enough property to tolerate rental reductions and still make a good rate of return on our money. So we're not calling the bottom of the market, but we certainly think it's attractive enough to come back to the UK.
Your property services division contributed a profit of £613,000 to 2009, numbers. Now, marginally down given how city dependent it is. Now, surely this year is going to be far worse.
Well, I've been cautious about that division of ours for the last couple of years, really, ever since the credit crunch kicked off, because of its high city client dependency. Its major clients are Canary Wharf based. People like Credit Suisse, Moody's, FSA, and so on. And they've done tremendously well to earn the £5.5 million revenue that they did and the profit of £600,000, which is actually nearly a 12% profit margin, which is much better than their peer group in the market. They're a very specialist team. They do a damn good job. And notwithstanding my expectation that they would come under pressure, they've bucked market trend. It's real profit. It's not fictitious profit, because we actually pay cash dividends out of that company to ourselves. And they've started the year well. So I don't know where it's going, but they've done very well. And if they continue to do what they believe they can, I expect we'll have another satisfactory, if not good, year.
Okay, now Ben, you reported a sharp drop in headline profits today, but operating profits rose from £2.62 million to £3.61 million. Now, why the disparity?
Well, last year, that's for the year to 31st March 2008, we had a very large performance fee paid to us by one of our funds, £5.65 million. The performance fee this year was £589,000. We still performed very well. Indeed, I ought to mention that we ranked top of the IPD benchmark for Central and Eastern Europe over the last 3 years. So we did very well for our clients, and are continuing to do very well for our clients on an absolute and relative basis. But the performance in the year to 31st March 2009 wasn't big enough or high enough to generate a large performance fee. So our performance fee income year on year reduced, but our underlying profits, excluding performance fees, which are very hard to predict and repeat, our underlying profits actually went up from 2.6 to 3.6 million. And that's a more fundamental measure of our strength and success, I think.
Mm-hmm. Okay, and what do you think you need to do, or the company needs to do, for the market to see this?
Well, I think the first thing we've got to do is raise a new fund. I think it's important that the market sees that we can diversify our client base and increase our assets under management in this market environment. The other thing we've got to do is communicate our investor story more clearly, which hopefully this interview will go towards doing. And thirdly, we've got to just go on doing what we do, which is growing revenue and growing profits, keeping our heads down and working hard.
Well, thank you very much, Ben.
Thank you very much. Thank you.
Now, hope you enjoyed this edition of Board Talk here on ShareCrazy.com. We'll see you in a short time soon with another Board Talk. Take care. Possums.